IFRS 10. IFRS 10 deals with the consolidated financial statements. So in this session, we'll discuss only basic concepts about consolidated financial statements. So there are different terminology being used while preparing the consolidated financial statements. So let us thorough with those terminology. So the first of all, what is this consolidated financial statements? So what is this consolidation meaning? Consolidation is nothing but adding financial statements of one or more companies. So when we will add and how we will add. So when we will add, first look at when we have to add financial statements of more than one companies. So I'll give one example. Suppose company A is there. So company A purchased shares of company B. Company B has a shares of 1000 shares. Let us assume company B is having 1000 shares. Out of these 1000 shares, 80%, that means 800 shares are purchased by company A, right? So company A purchased the shares means where it will appear in company A financials. So it will appear as an investment, right? As an asset in financial statements of A, because A purchased 800 shares of company B. So in a company B, total share capital is 1000, right? This total share capital will appear in as liability, equity in financial statements of company B. So if we look at this transaction, almost 80% of shares of B are held by A. That means whatever decisions are being taken in company B are influenced by company A, because most of the shares are held by company A. This is called control. Company A is said to have control over company B. Of course, there are a lot of other topics with respect to control. It's not just only the share capital and percentage of share capital. So there are also certain other conditions that determines the control that we will look into. So first let us understand this holding of shares and how the companies will purchase shares of other companies, right? So take the same example here. The company A held 80% of the shares are held by company A, right? This company A is said to have control over company B. Company A is called parent company. That means the company which has control over other company, right? Company B is called subsidiary company, right? So this is called parent subsidiary relationship. To establish this parent subsidiary relationship, control should exist. So we will discuss what is this control, what are the conditions to be satisfied to have this effective control, that we will discuss, right? So company A purchase shares of company B. Similarly, company A may also purchase shares of company D, company XYZ. So more than 50% shares it can purchase. So company A may have number of subsidiaries, right? So parent company A may have more than one subsidiaries. In consolidated financial statements, so we have to prepare single financial statement by clubbing financial statements of parent as well as subsidiaries. This is called group accounting. So let us discuss one by one. So in our example, so company A held 80% shares of company B, right? So there are remaining 20% shares which are held by other than company A. That 20% is called non-controlling interest. So that is the concept of control. One company controlling the other company through shares. So now let us understand the definitions. What is a group? Group is formed when one company known as parent acquires control over another company known as subsidiary. So this is called group. So parent acquires control over another company, which is known as subsidiary. In our example, here the control acquired through voting rights, share capital. So 80% of the shares are held by company B, company A in company B. So that is called parent subsidiary relationship. Group will be formed when parent acquires control over another company known as subsidiary. Now we have to understand what is control. Is control means having just more than 50% is a control, or are there any other conditions to be satisfied? Yes, there are other conditions to be satisfied apart from 50%, more than 50% holding. So when the control is said to have when parent owes more than 50% shares. Of course, if we have more than 50% shares, that means we will definitely have control over the other company. Even if parent own less than 50% shares, still control exists. So what are the situations where control exists where parent own less than 50% shares? So there are certain definitions given for control. Investor controls the investee if it has power over the investee to direct the relevant activities. That means parent should have power over subsidiary to direct the relevant activities. That means it has complete control to direct the operational activities of the subsidiary. That means parent, suppose if subsidiary wants to open a branch, new branch. So who has to take the decision? Parent has the power to direct the activity, whether subsidiary needs to open a branch or not. So subsidiary wants to sell a new product in the market. So who has the power to take the decision? Parent has the power over the investee to direct that relevant activity. That means there is a complete control over the subsidiary to direct the relevant activities. Second, exposure or rights to variable returns from its involvement with the investee. So exposure or rights to variable returns. So how parent will get variable returns? Parent will get variable returns in the form of dividends, right? So parent will invest in the subsidiary in the form of shares. In return, what parent will get? Parent will get dividend on the shares invested in the subsidiary, right? So how it get those variable returns, how it will get the dividends? Dividends will get by the parent when it has complete involvement with the investee. When it has complete involvement with the investee, and if it participate in the operations of the subsidiary, then the subsidiary will run into profits. If subsidiary is into profits, who will benefit? Parent will benefit. How parent will be benefited? Parent will be benefited in the form of variable returns. Variable returns is nothing but dividends, right? So as long as parent involves in the activities of the subsidiary, who will get benefited? Parent only will get benefited in the form of variable returns. If subsidiary is into profits, who will get benefited? Parent will get benefited because it was more than 50% shares, or it will completely participate in the affairs of the subsidiary, right? So these returns will be affected. How these returns will get affected? Parent has ability to use its power over the investee to affect investors' returns. So it will use its power over the investee. What are those powers? Powers could be appointing members of the board. So because board is the ultimate authority to run the business, to manage the business, to affect the performance of the business. So if parent appoint good skilled board of directors, definitely the investors returns will get affected. Returns means dividends, share in the profits. So if parent appoints good skilled board of directors, then subsidiary will get perform well, If subsidiary performs well, so the investor means parent, will get benefited. So this is the definition of control given in IFRS 10. Investor controls the investee when it has power over the investee to direct the activities, if it has rights to variable returns from its involvement, it has ability to use its power over the investee to affect the returns, investor returns. So how this control exists, even if parent own less than 50% shares. So if parent owns more than 50% shares, that means it has more than 50% voting rights in a meetings, right? If it has more than 50% voting rights, it has a power to participate in the annual general meetings. It has a power to appoint the members of the board, right? Even if it has owned less than 50% shares, still the parent will have control. Still the control exists. So what are those cases? Very important situations. These you will get in an examination to determine whether the control exists or not. Parent is said to have control even if it owns less than 50% of the shares. So what are those situations? Situation 1. If parent has a power to govern the policies of the entity. Policies could be financial policies, operating policies. So if it has a power to govern the financial or operating policies of the entity, then control exists even parent owes less than 50% of the shares. If it owns less than 50% of the shares also, still control exists if it has a power to govern the financial or operating policies of the entity. What are the examples of financial and operating policies of the company? For example, company wants to take a huge loan from the bank, or company wants to issue a fresh issue in the market, or company wants to buy debentures from the market, or company wants to issue the debentures. These are all financial policies, right? So why company would need a debt? Company will need a debt to expand its operations, or to invest in assets, or to open a new branch. So this is a financial policy. Who has a power to operate this financial policy? If parent has a power to govern the policy. To govern the policy means to approve the policy. It will not just participate in the meeting. It has a power to decide whether the company has to take a loan or company should not take a loan. So parent should have a power to govern that financial policy. Similarly, operational policies. Operational policies means launching of a new product, or taking a huge advertisement campaigns for the products. These are all operational policies. So if parent has a power to approve those operational policies, power to govern the operational policies, then parent is said to have control even it own less than 50% of the shares. How it has a operational power over the financial or operating policies? Through an agreement. Generally these powers will be given through an agreement with the shareholders. Generally the parents will have power to participate in the general meetings, and their ownership voting rights will depend upon their shareholding. If they have less than 50% shares, they don't have more voting rights. Even though they don't have more voting rights. Here more voting rights means more than 50% voting rights. Even though they don't have more than 50% voting rights, through a virtue of agreement between the company and shareholders, they may have power to govern the financial and operating policies of the company. In such a case, control exists even parent own less than 50% of the shares. Second situation, if parent has more than 50% voting rights in a board meeting, right? So in a board meeting, if a company has more than 50% voting rights, then also control still exists. Third situation, if parent has a power to appoint, to resign, to make board of directors resign, or to remove majority of members of the board of directors. So I've already told who will appoint the board of directors. Shareholders will appoint the board of directors, right? Shareholders means company. Shareholders means company, right? So we know shareholders are appointed by the board of directors are appointed by the shareholders, right? If shareholder is nothing but, in our case, parent is a shareholder. Company A is a shareholder in a company B. Why company A acquires, purchases shares of company B. So company A is a shareholder, right? So here company is a parent, right? If parent has right to appoint, to resign, to remove majority of the members of the board, that means parent has a power to appoint majority of the members of the board. Parent has a power to remove the majority of the board of directors. Then it is said to have control. Why? The business, the company, who will manage the company? Board of directors will manage the company. If parent has a power over those board of directors, then that means parent is said to have control, even if it own less than 50% shares, right? And if it has right to appoint majority of members of the board, means what? It has more than 50% voting rights in a board meeting. So it will come through an agreement, right? Agreement between the shareholder and the company. So these kind of agreements we will see in a family managed businesses, where one person will incorporate the company. Though he own less than 50% of the shares, he still have control over the board, right? That control will be given through agreement. He still have power to govern the policies of the entity. He still have more than 50% voting rights in a board meeting. He will have right to appoint, resign, remove majority of board of directors of the company. And it has a power over 50%, more than 50% voting rights by agreement with the other investors. More than 50% voting rights means in a general meeting. This is not more than 50% in a board meeting. These more than 50% voting rights with respect to shares. Though it owns less than 50% shares, it has a power of more than 50% voting rights. That will be given through an agreement with the investors. So if any of these situations exist, then control still exists, even parent own less than 50% shares. So this is about control. So this definition is also very important. So in an examination, if we have to analyze the control concept, then you have to write these 3 points. Control exists when it has a power over the investor to direct the activities. If it has a right to variable returns from its involvement with the investee, it has the ability to use its power over the investee to affect investors' returns. If control is said to have, this is the definition of control. And control exists even when parent own less than 50% shares. How that will come? That will come by agreement with the other investors. What are those powers? Power to govern the policies of the entity, whether it could be financial policies or operating policies. More than 50% voting rights in a board meeting, so that they have a right to appoint, remove majority of the members of the board. And it has more than 50% voting rights by virtue of agreement with the other investors. So if any of these conditions are satisfied, then parent is said to have control over the subsidiary. Now, so let us look at, so now we understood what is group. Group is nothing but parent and subsidiaries together is called group. And we also understood what is control, and we also understood what is parent and what is subsidiary. Now let us understood what is NCI, non-controlling interest. So if parent own 80% shares of subsidiary, that means in our example, A hold 80% shares of company B. The remaining 20% shares are held by others. That could be 1%, 2%, or 10%, or 100%, or lakhs of persons, right? The other 20% is called NCI, non-controlling interest, right? The non-controlling interest will not prepare any consolidated financials. Who will prepare the consolidated financials? Consolidated financials are being prepared only by the parent company, right? So now let us look at these definitions. Group, parent and all its subsidiaries together is called group. Subsidiary, subsidiary is a company controlled by the other company called parent. Parent, parent is a company that controls one or more subsidiaries. Non-controlling interest. Non-controlling interest is the equity in a subsidiary not belonging to the parent. That means in our example, 20%. Equity is there in a subsidiary, but that equity is not belongs to the parent. That 20% is not belongs to the parent. That 20% is called NCI, non-controlling interest. Next, so far we have learned about parent subsidiary. There is also a other concept called associate. What is associate? So I'll give example of this associate. So take an example, the same example of company A and company B. Company A purchased 30% shares of company B. So company A is there, company B is there. So company A purchased 30% shares of company B. And this company A is said to have, in such a case, company A is said to have significant influence over company B. What is significant influence? Since company has 30% shares in company B, so it has power to participate in the financial and operating policies of the investee, but it don't have control since it has only 30% shares, right? But it has a power to participate in the financial and operating policies of the company B. For example, I told company A hold 80% in our earlier example. Now take the example, company A hold 20% shares, 30% shares in company B, and remaining 70% is held by company C. Let us say company A held 30% shares and company C has 70% shares in company B. Company C is a parent company. It has a power to govern the policies. But company A also has a certain powers. What powers company A has? Company A has a power for participation. It has a power to participate in the financial and operating decisions of the company. What is participation? Participation means involvement. It can raise its voice. It can say what is its decision. But ultimate decision is with the parent company, that is company C, but it has a significant influence. That means it has a power to participate in voting rights because it has 30% voting rights. It has a power to raise his voice. It has a power of participation in while appointing the board of directors, while taking any decisions in meetings. It has a power to participate. That is called significant influence. not a major influence, but it is said to have significant influence. If a shareholder has just 10% or 5% or 1%, then it is said to have, they don't have that much of significant influence. But if that company holds equal to or more than 20% but less than 50%, then it is presumed to have, it has significant influence. Then that company is called associate, and there is a separate accounting treatment being given for this associate that we will discuss in a later slides, how to do the accounting and all. But here you should understand what is this associate. Associate means the company which has some significant influence, but it don't have a control, but it has significant influence to participate in the meetings, significant influence to raise its voice. If it has some 5% or 2% shares, even if it raises its voice, the other investors may not listen to them. But it has 20%, 30% shares, their voice can be listened by the other investors because it is said to have significant influence. It invested more than 20%, 20%, 25%, 30% shares. That is the concept of associate, having significant influence. Next, we also have potential voting rights. Potential equity shares means instruments that will get converted into equity shares at a future date, right? If they get converted into future equity shares at a future date, they will have their voting rights will get increased, right? So if their voting rights get increased, then they will have control also. Suppose now company A is having 45% voting rights, but their other instruments will get converted into equity at a later date so that they can acquire additional 10% voting rights. That means now they have 45%. But while after conversion of these potential shares, they will acquire additional right of 10% so that their voting rights will become 55%. Right? Though now they hold 45%, but at a future date, after this conversion, they'll get a voting rights of 55%. These additional voting rights also should be considered now while defining parent subsidiary relationship and while defining this control. That is called potential voting rights. Like options, share warrants, debentures, there are a lot of other instruments that are convertible into shares, ordinary shares at a future date, right? If they are converted, the entity will get additional voting rights, right? That is called potential voting rights. And while assessing whether control exists or not, we have to consider these potential voting rights also into consideration while computing the control. Understood? That this is a simple example. We have 45% voting rights now. In future, after conversion of these instruments, company will acquire additional 10% voting rights. That additional 10% also we have to consider now while assessing the control. That means 45 will become 55. That means entity A is said to have control. Though it holds 45% now, that will become 55% in future. But that control we have to consider now only because those instruments are being held by that entity now only, right? Though they will convert in future, that potential voting rights we have to consider now while assessing the control. This is also an important concept, consideration of potential voting rights while assessing control. Right? So let us summarize this. Then we can discuss if anybody has any doubts. Subsidiary. What is the criteria? General criteria is more than 50% rule. more than 50% rule can be with respect to voting rights or can be with respect to voting rights through agreement. Though they own less than 50% voting rights, they can have control to control more than majority of board of directors. They can have control to appoint, remove more than 50% of majority of board of directors. Then control is said to have. Then that investment in other entity is called subsidiary, and we have to prepare the financial statements using full consolidation method as per IFRS 10. So who will prepare these financial statements? Parent will prepare the financial statements. Significant influence. This also we have discussed, 20% plus rule. So though an entity may not have control, but it has some significant influence. That means it has a power to raise its voice. It has a power to participate in a meetings of the company. It can express its concerns. It can participate in the meetings. It can raise its voice. Then it is called associate. Then we have to comply with the standard IAS 28 equity accounting. This also we will discuss. This IFRS 10, IAS 28 we will discuss in our next slides. Next, simple investment. Simple investment means we just purchased 1% shares of the company or 0.5% shares of the company or 0.6% shares of the company. Simple investment. Simple investment means we will account for just at cost or at fair value. IFRS 9 is applicable. This also we will discuss, right? So this is how, these are the various types of investment, and this is how we have to account for in the books of accounts. So I told you a simple investment.
Repeat on investment.
Right. So separate financial statements are required to be prepared by the parent and subsidiary without considering this consolidation, right? So see the second point, both the parent and the subsidiary continue to exist as a separate legal entities because they are separate companies. These companies are incorporated separately. They are separate legal entities. Company A, Company B, Company C, they are separate legal entities and they are required to produce their separate financial statements. That is called standalone financial statements, right? So while preparing the separate financial statements, in parent books, we have investment in subsidiary, right? So it will have investment in subsidiary on the asset side of the parent books because parent purchased the shares. If parent purchased the shares means parent is invested in the shares. That investment is a asset that will be included in the non-current investment, included as a non-current investment on the asset side of the balance sheet, right? That investment in subsidiary has to be recorded at cost or fair value in a separate financial statements. Take an example. Parent A purchased 80% shares of parent B at price of $2,000, right? So parent A purchased shares of parent B at a $2,000. So what entry parent will pass? Parent will pass debit investment, credit cash, right? At what rate it purchased? At a rate of $2,000. So where this $2,000 will appear? This $2,000 will appear as non-current investment on the asset side of balance sheet of parent A in the separate financials. I'm talking about separate financials. I'm not talking about consolidation. So I'm talking about separate financials. So in separate financials, this investment in subsidiary has to be valued at cost or fair value. This fair value concept we will discuss in IFRS 9. So there we will discuss about what is this fair value and what is this cost. There is a separate concept is there. So let us understand. In separate financial statements, investment in subsidiary will be recorded either at cost or fair value. In some cases, if the investment, see the last para, where the subsidiaries are classified as held for sale, that means we are going to sell our investment in subsidiary. Then we have to comply with IFRS 5. This also we will discuss in a separate chapter, IFRS 5, investment held for sale. So we have this IFRS 5 chapter also in our F7 syllabus. This also we will discuss in our revision classes. Right? So what I'm trying to make here is, apart from this consolidation, each company, whether it is parent or subsidiary, has to prepare their separate financial statements. They have to prepare their own separate financial statements. That is called standalone financial statements. Next, let us discuss one example of the control. Which one or more of the following would be accounted for as subsidiary of A? So A has different investments in different companies. So we have to evaluate who are the subsidiaries of A. Point number 1. A holds no shares in B, 0 shares in B. However, through an agreement with the B's shareholders, that means B's 100% investors are there, no? So with the agreement with the 100% investors of B, A chooses 6 of the 10 board members. That means A has a right to choose, that means to appoint 6 out of 10. That means more than 50% of the members of the board can be appointed by the A, even though A holds 0 shares in a B. How A has this power? A has this power through an agreement with the other shareholders, that means 100% shareholders of the B. So whether A is a parent or not, whether B is a subsidiary, since A has a power to appoint more than 50% of board of directors, A is a parent and B is a subsidiary of A. So in one, B is a subsidiary. Let us take point number 2. A owns 45% of C shares. No other individual shareholder owns more than 5%. That means A owns 45% shares. We have other 55% shares, right? That 55% shares are scattered by different shareholders, and each shareholder owns less than 5%. That means 5%, 4%, 3%, 2%, 4%, 1%, 1.5%. Adding together, it is coming to 55%. That means remaining 55% shares are held by individual shareholders, and each shareholder holds less than 5% shares. Now my question is, A owns 45% of C shares. So what is the position of A? A is parent or A is associate? So in case number 2, 45% are held by A. That means equal to or more than 20%. If a company hold equal to more than 20% shares, then it is said to have significant influence. More than 45% are held by A, but company A don't have control. Control means it should hold more than 50% shares, or control should exist through an agreement. Here there is no agreement, and here A is not holding more than 50% shares. So there is no control in point number 2, but it is, since it has more than 20% shares, it is said to have significant influence. C is an associate, not a subsidiary. So there is no parent subsidiary relationship here. So coming to point number 3, A owns 55% of D's shares. Okay, it is holding more than 50% shares. Under a contract in place, A must make all decisions in agreement with E, who owns 45% of the shares.
A is parent to D and E.
So here A owns 55% of D shares. So here the question is whether D is a subsidiary of A or D is a subsidiary of E. That is the question here. A owns 55% of D shares. Here they own more than 50% shares, right? But there is an agreement with E. So E is another shareholder. So there is an agreement with E, who owns 45% shares. All the decisions. So whatever the decisions that has been taken with respect to company D, who has a power? E has a power, right? Under a contract, through a contract, A must make all decisions. A means the other shareholder who owns 55% shares. The other shareholder has a power to take decisions only in agreement with E. That means E has to accept the decision. Who owns 45%? If you see, we have only two shareholders, right? A and E. D is a company. D company shares are held by two persons, A and E. A owns 55%, E owns 45%, but who has control over these decisions? E has control. A cannot take decision without the acceptance of E. Now tell me, who is a subsidiary? D is subsidiary of A or D is a subsidiary of E? Point number 3, who is a subsidiary of A? E, no one is a subsidiary of A. So D is a subsidiary of E because E has control over D. A don't have control over D. Though it holds majority of the shares, all the decisions should be taken in agreement with E. All decisions should be taken in agreement with E. So here E is a parent, D is a subsidiary. A is not a parent and D is not a subsidiary of A. Next, point number 4. A controls F, a partnership under an agreement. So remember, subsidiary need not be a company. It doesn't mean voting rights through shares will come. Even the control can be in case of a company or control can be in case of a partnership. Here A controls F, a partnership under a agreement. So A controls F means F is a subsidiary of A. Subsidiary means subsidiary can be a company or subsidiary can be a partnership also. So at F7 level, we will discuss about companies, but if you go to the further levels of SBR, we will discuss about the consolidation of partnership firms also. But at this level, we will discuss about consolidation of companies, subsidiaries who are companies. But here, F is also a subsidiary of A. So what are the correct options in point number? So what is the question here? Which one of the following would be accounted for as subsidiary of A? In question number A, B is a subsidiary, though A holds 0 shares through an agreement. Here C is not a subsidiary, C is an associate. Here D is not a subsidiary of A, D is a subsidiary of E. So 2 and 3 are not satisfied, A satisfied, and 4, yes, F is a subsidiary because it controls partnership through agreement. So what are the correct answers? 1 and 4 are correct. So this next slide is about exemption from consolidation. Very important. So this also we may get some of the questions with respect to exemptions from consolidation. Who are not required to prepare consolidated financial statements, though it has control. So far we have discussed that if parent has control, it has to prepare consolidated financial statements by clubbing financials of subsidiaries, right? Though it has a control, it need not prepare consolidated financial statements. What are those cases? So listen carefully. The parent itself is a wholly owned subsidiary or partially owned subsidiary of another entity. So I will give an example of this. Company B held, it purchased, acquired 80% shares of C, and it has control because there are no other conditions with respect to control. So since company B purchased 80% shares of C, company B is a parent, right? Company C is a subsidiary because company B is controlling company C. Company B purchased 80% shares of company C. Here company B is a parent, right? Take another example, company A. Company A purchased 100% shares of company B, right? Here company B also have share capital. Company B shares are purchased by company A. So if you see this ABC, company A is a parent company and company B is a subsidiary of A. It is a wholly owned subsidiary of A. Wholly owned means entire shares of company B are held by company A. Understood? So let me give this one Excel example so that you can better understood this concept. Yeah. So we have, I'm giving you this example. Company B, company B, company C, and company A. So company C shares. Company C has 1,000 shares, right? Company C has 1,000 shares means share capital. So assume $1,000 is the share capital, right? So $1,000 share capital is there in company B. Out of this $1,000 share capital, company B acquires 80% of C. That means assume the acquisition is at par value. That means face value. That means $800, right? So out of the shares of company C, 1,000 share capital, 80% of the shares, 80% of the shares out of these 1,000 shares, 80% of the shares, that means 800 shares are held by company B, right? So where it will appear as investment, right? Investment in company B balance sheet, SFP. So because it purchased 80% of shares of company C. Since it purchased 80% of company C shares, it is said to have control because there are no other conditions like other investors will have control like that. There are no other conditions. If there are no other conditions, if it holds more than 50%, then it is said to have control. So in such a case, company C is a subsidiary of company B, right? So company B is a parent, right? Company B is a parent and company C is a subsidiary of company B. Now, so here we know company B is a parent and company C is a subsidiary. Now come to company A. Company B also will have some shares. When company B is incorporated, it should have its own share capital. So company B has 2000 shares. That means $2,000 share capital, right? And these 2000 shares are held by company A. Company A acquires 100% of B shares. That means how much it purchased, assuming purchased at face value, par value, right? So investment in company B. Here investment in company, okay, so investment in company B, so will be shown in company A financial statements. Here investment in company C will be shown in company B finance balance sheet. So listen this carefully. So this part you understood, right? Company B acquires 80% shares of company C. Company C has 1000 share capital. Out of this 1000, 80% is held by company B, right? So since it held by company B is said to have control over company C. That is the reason why company B is a parent, company C is a subsidiary of company B. So company B also has share capital of 2000 and this entire share capital, 100% of the shares are held by whom? 100% of the shares are held by company A. That means company A is controlling company B. Here company A is parent and company B is subsidiary of company A, right? So if you see here, company B is acting as a parent to company C and company B is acting as a subsidiary of company A. That means here company B is parent as well as subsidiary. Since company B is a subsidiary of company A is called ultimate parent company. A will prepare the consolidated financial statements. D is not required to prepare consolidated financial statements because A is already being prepared in the consolidated financial statements. It will consolidate B and C as well because A indirectly controlling the C also. Because how company B is being controlled by company A. That means company A will control company C also. This is called indirect control. So this we will discuss in SBR, the next level of accountancy. So here we will not discuss any questions about indirect controlling. So we will discuss direct controlling only at F7 level. But you should understand while knowing the exemptions, you should understand this indirect controlship, right? So in this case, who will prepare the consolidated financials? A will prepare the consolidated financials, not B, though B is a parent company. So this is called This is one of the exemption. Ultimate parent company will prepare the consolidated financial statements. Right, so that is the one of the exemption. Parent itself is a wholly owned subsidiary, or it could be a partially owned. That means it can be a 80% or 70% or 60% partially owned subsidiary of another entity. And so here all the following conditions should be satisfied to avail this exemption, right? And parents' debt or equity instruments are not listed in a public market. That means if the shares are traded, then it has to prepare consolidation even if it is a wholly owned subsidiary of other company. If the shares are listed, that means listed companies. If they're listed in a stock exchange, public market, if the shares or debt or equity instruments are listed in a stock exchange, then it has to prepare consolidation. If they are not listed, then it is exempted from preparing consolidation. Even though if it is not listed, if it is in the process of filing, that means it has applied for listing with the stock exchange. If it has applied for the listing in a stock exchange, then it has to prepare consolidation, even though it is not listed. That means parent should not file, or parent should not be in the process of listing with the Securities Commission, that means SEBI or other regulatory organization, SEBI or other stock exchanges. It should not file, or it should not be in the process of listing. If it is in the process of listing, no exemption. If it is not in the process of listing, there is an exemption. Next, ultimate or intermediate parent publishes the consolidated financial statements. Here in our example, company A should publish consolidation. If company is not publishing consolidation, then this exemption is not applicable. Company B has to prepare financial statements. So these are the exemptions from consolidation. Very important exemptions. You may get an example in our examination also. So let us revise this once again. So let us take company B as parent in our example to conclude these exemptions. Company B is not required to prepare the consolidation when it is a subsidiary of another entity. Condition number 1. Condition number 2, that other entity, that means that parent company, company A, should prepare consolidated financial statements. Condition number 2. Condition number 3, parent, that means company B, is not listed in a stock exchange. Condition number 4, company B is not in the process of listing, or company B is not filed any listing process with the regulatory authority like SEBI or stock exchanges. If all these 4 conditions are satisfied, then company B is not required to prepare consolidation. Who will prepare? Company A, ultimate parent company it could be, or it could be a intermediate. Company A become a subsidiary of company X also, right? The ultimate parent company should prepare consolidated financial statements, and company B is exempted from preparing consolidated financial statements. So this is about not consolidating a subsidiary, right? So companies may try to avoid consolidating a subsidiary by stating certain reasons. The reasons could be, the parent can say the activities of the subsidiary and activities of the parent are completely different. So consolidation may not give a correct picture, so I don't consolidate. So that is one of the reasons that companies may wish not to consolidate. And the other reason could be, parent may say that my investment in a subsidiary is a temporary. I will dispose that investment after 2 years or 3 years, so I don't consolidate. That could be the another reason that company may quote to avoid the consolidation. And subsidiaries is a loss making. So since subsidiary is a loss making, consolidation may not give correct picture, so I don't consolidate. Since there is a huge subsidiary loans in a company, so if I consolidate, consolidation will not give a correct picture, so I don't consolidate. So these reasons may be quoted by the company to avoid consolidation. The last reason is legal conditions restricting the parent's ability to run the subsidiary. So if there are certain legal restrictions to run the subsidiary, that means court has ordered not to run the subsidiary. In such a case, parent company may say that since the subsidiary is not being run by me, since there are certain legal restrictions, I will not consolidate. Right? So listen this carefully. So there are 5 different reasons for not consolidating the company. Directors may not wish to consolidate a subsidiary by quoting these conditions. What is the first condition? Activities of the subsidiary and the other parent or other group are different, and investment in subsidiary is a temporary, subsidiary is a loss making, subsidiary is having huge loans, consolidation will not give correct picture. Legal restrictions. Legal restrictions means court has ordered or as per Companies Act or some other statute says that parent may not require to run the subsidiary. That means consolidation is not required. So these are the 5 conditions that directors may wish not to consolidate a company, but as per IFRS, except from the legal restriction, other reasons are not permitted according to IFRS, and consolidation is required even subsidiary is a loss making, even subsidiary is having a huge loans, even control is temporary, even activities, subsidiary activities are different from the parent activities. This is also very important condition that you people should aware. Right? So this is about non-consolidation of a company. When a subsidiary cannot be consolidated, subsidiary cannot be consolidated if there are any legal restrictions that avoid parent being consolidating a subsidiary. Next, other rules. Other rules for consolidation, very important. Parent and subsidiaries should follow same accounting policies. Same accounting policies means, for example, parent is following WDV method of accounting for depreciation. Subsidiary is following straight line method of accounting for depreciation. Then that is not a same accounting policy, right? In such a case, subsidiary company has to change its accounting policy, and we have to subsidiary B has to prepare another set of financial statements by preparing depreciation as per WDV method, because company A is following WDV, company B should also follow WDV method. Similarly, inventory accounting, FIFO, LIFO. So same accounting policy should be used by parent and subsidiary companies. If any difference is there, adjustments has to be made. Anyways, this is not a syllabus of our F7. These adjustments will be discussed in our further level of examination. These adjustments part are not relevant at F7, but you should know this theory. For consolidation, same accounting policy should be used. And reporting dates. Reporting dates of parent and subsidiary should be same. In case of difference, the difference should be less than 3 months. Suppose company is preparing its financials still from Jan to December. Parent is preparing from Jan to December. and subsidiary is preparing April to March. So that means there is a difference, there is a gap of 3 months. We are consolidating December financials, right? So parent is consolidating Jan to December financials and subsidiary will consolidate it only Jan to December. That 3 months transactions will not be consolidated by the parent, but if any major transactions happen between these 3 months, that adjustments has to be considered in the consolidation. But the period should be Jan to December for parent and Jan to December for subsidiary. If any significant transactions are there for the 3 months, that has to be adjusted, right? So this also will not be tested in F7 paper, but you should know this theory. Reporting date should be same. In case of difference, the difference should be less than 3 months. So these are general rules and consolidated techniques. So we will quickly revise about these consolidation techniques and the examples we can discuss in our next session. What technique we have to follow while consolidating these parents and subsidiaries? First technique is simply adding all assets, liabilities, incomes and expenses. Remember, students will confuse in this area, so they will get a doubt. So take an example. Company A has assets of $100. Company B also has the asset of $100 and company A controls 80%. Take this example. So company A is a parent and company B is a subsidiary and it has non-current assets. Company A has a non-current assets of 100 and company B has a non-current assets of another 100. So company B also has a non-current assets of 100, right? Now parent has a control of 80% over company B, right? So as per the first technique, consolidation means adding together all assets, all liabilities, incomes and expenses. Now my question is, how do we consolidate? Do we consolidate 80 plus 80 or 80 plus? Since parent A control only 80% of the assets, we will add only 80% of non-current assets. That means 180. So what number we have to take in consolidated financials? 2. So here, though parent owns 80% of the shares, we have to add all the assets and liabilities, not 100% of parent and 80% of subsidiary. As per IFRS 10 consolidation of financial statements, we have to club together all the assets, liabilities, incomes and expenses of parent and subsidiaries. Whatever is not owned by parent, that is 20%, that we will show separately as a liability because here we are adding assets and liabilities, right? So whatever is not owned by parent, that we will show separately as non-controlling interest. So that is the first technique. Consolidation means adding together all assets, liabilities, incomes and expenses. Next, show parents' share capital and share premium only. This is also very important. This also I will give an example. Subsidiary has a share capital of 100 and parent has a investment of 80 because share capital is 100. How much has been held by parent? Parent has purchased 80% shares. Assume parent has purchased at a face value. Parent may purchase at face value at a higher value also. Take this example. Now we are consolidating parent and subsidiary, right? While consolidating parent and subsidiary, we have to take share capital of parent only. We should not take share capital of subsidiary. Why? This share capital of subsidiary we have to eliminate with this investment, right? So for the why? Because parent is holding 80% shares of subsidiary. Parent is having investment for that portion and subsidiary is having share capital for that portion. Both should be eliminated because now parent and subsidiary both are a single entity. They are not separate entities. We have to eliminate this transaction of investment and share capital, right? So how do we eliminate? So this 80 and 80 we will eliminate, and this 20 is there, right? 20 is being held by non-controlling interest. This 20 we will show separately as non-controlling interest, but not as a share capital. But parent is holding how much share capital? 80% share capital parent is holding, right? That 80 we will eliminate with this 80, this liability 80 credit, and this asset 80 debit. The both 80 and 80 will get eliminated, and 20 is there, 20%. That 20% is being held by non-controlling interest. That we will show separately as non-controlling interest, but not as a share capital of subsidiary. There is no share capital of subsidiary because we are clubbing parent and subsidiary. Now A and B are single entity. Entity will have only one share capital, that is the share capital of parent. Very important concept and very important logic. Show parent's share capital and share premium only. Next, cancellation of like items internal to the group. That means we would have transactions between parent and subsidiary. Purchases, sales, all these transactions has to be cancelled. Like how we cancel investment against share capital, there could be purchase in parent and sale in B. That means A purchased goods from B. So that elimination also we have to do. That we will discuss in depth in our next slides. Next, consolidate as if you owned everything. That is what I told the first point. Consolidate everything, 100 plus 100. Then show the extent to which you do not own as NCA. So first add everything and then show whatever you do not own as NCA, non-controlling interest. Consolidated reserves. We have spoke about equity, share capital plus premiums. But balance sheet will also have reserves, right? Parent reserves and subsidiary reserves. So we have to consolidated reserves comprises parent reserves plus share of subsidiary reserves. That means subsidiary profits 80% belong to parent and 20% belong to non-controlling interest. So while preparing consolidated reserves, we have to add parent reserves plus parent's share in subsidiary reserves. That is 80% only we will add. Balance 20% will be added to NCI. So these are the basic techniques of consolidation. So this we will better understood when we do these solutions to the examples. For each case we have separate examples. So while solving those examples, we will understand in a better way what is this reserves concept, what is this NCI, so how to eliminate the like items, all this we will understand.